In this video, we are going to be talking about what is market liquidity, the difference between larger and smaller coins, how does the liquidity model work and what does it do, and how you can maximize your growth potential on the bots platform. So today I want to start out with having a look at CoinMarketCap and to give you a little bit of an idea of how much volume is in the different coins. And as you can see immediately, well, we have at the top of the list, we have XRP. Keep in mind, these numbers can be completely different when you're watching this video, as volume always changes with the market. But the main takeaway from this, what you should look at, is that the volume can be very different in terms of the number 1 to the number 5 or number 10, as Ripple has traded quite a lot more than Bitcoin has over the past 30 days, even though the market cap of Bitcoin is a lot higher. So to give you a better idea of what liquidity is, we're going to have a look at the order book of Binance. This is for Bitcoin USDT, and here you have an overview of how much volume is available at what price levels. So these transactions at the top don't mean that they've already been executed. These just means that there is, for instance, if we look at this one, it had 56,000 USDT worth of Bitcoin for offer at that price, because this is the ask. And these volumes are quite big. You can see it around about 300, 400, 500, 200,000 USDT, which are relatively large positions. And even for the bots platform, it's in general not an issue to get in and out of the Bitcoin trades, because there's so much volume going on. However, I also picked a different coin that is quite a lot lower on the list, which is Cake. And that looks quite a lot different, because where we were talking with Bitcoin USDT, we were talking about increments of 200,000 or 300,000 USDT available. Here, for instance, we have a price level that has only 631 USDT available. So if you want to sell for that price, it's going to be really hard to put your large position into the market. Because with bots, as you know, we have a lot of users, so this also means that the amount of assets under management is going to be quite large. So you need to take this into account. Because if you can't get in on the right price, the trade doesn't mean that much, because timing is everything, and getting in on the right price is equally as important as just a specific trade. And I also want to show you a little bit of a real world example. Here I've drawn out a hypothetical scenario. This is the order book for Bitcoin. And here we have the bid and the ask. And these numbers are the different price levels that we have. And here are the corresponding volumes that we have available at those price levels. These all need to be multiplied by 1,000. And as you can see, for Bitcoin, there's a lot of money available at the different levels, because these are only increments of 0.02%. But even still, we have 500,000 here, we have 126k there, and even 250,000 down there. So it's not very likely to run into any kind of liquidity issues where you're trying to get rid of 1 million USDT. However, what you need to imagine is that when you're trying to sell, and we're trying to sell $1 million, for instance, that means that we saw this wonderful price of 45,320. But that doesn't mean that we are going to be able to exit our entire position at that price, because there's only 83k available. So what do we do next? We go to a slightly lower level at the 310 and pick up slightly more of our trade. And down we go. But the end of the story means that since we have 1 million euros to spread over this entire order book, we're going to be taking some at this price, some at this price, some at this price, some at this price, and also at this, which means that overall we got less for the position that we sold. And as you can see here, the damage is not that bad because every step is only 0.02%. So overall, we're not actually losing that much. We have five different levels on which we can unload our position, which means that the variation is only 0.1%. However, this is in Bitcoin. Bitcoin is a massive market. So I also want to have a look at a different scenario, because here we tried to put $1 million USDT in Bitcoin, which is laughably easy because there's so much liquidity available. Now we come to a scenario where the bot creator has a bot that has a very wild idea. It's going to trade in Cake. And Cake is was number 45 at the time of recording this video. So that shouldn't look too bad, right? Unfortunately, that's not the case. You can quite clearly see that these are the same steps percentage-wise as with Bitcoin for the price levels, but the amount of volume available is so much lower, so you're never ever going to get your $1 million USDT filled. Like, you get 9 grand here, 5 grand there, 3.5 there. It's going to take ages and lots of different price levels to actually get out of your position. And that doesn't sound too bad. I mean, just takes a little bit longer to get out of the position. What's the big whoop? But keep in mind that if the markets do crash or roll over or they have a strong correction, you want to be out quickly. You don't want to wait until you're down 5 or 6 or more percent because you have such a large position. Because this is the number 45, 43, something like this. But imagine that you're trading in coin number 150 and you have $1 million USDT involved. You're going to mess up the entire market and you can get stuck in a position because you have so much of this coin that you're going to influence the entire price. Well, to stop this from happening, we have a liquidity model. What this model does, it is always scanning the assets that you're trading for how much liquidity is available. So how much can we reasonably expect to put in the market when we really need to? So when stuff hits the fan, we want to be able to get out quickly and not get stuck in our positions, which can give massive losses. So the reason we do this is to maintain the quality standards at the bots platform, and that in case something goes wrong, we can always exit our positions and we can safeguard the investments from our users. So this describes the problem, that is that there's not enough liquidity available in these smaller coins. And this can mean that you have very large slippage, pay too much, get too little, all kinds of nasty scenarios where you can lose 10, 20, 30, 70%, whatever. And the solution we have for this is the liquidity model, and the liquidity model is basically nothing more than a formula that calculates how much liquidity is on average available in these markets, so that we can always make sure that we can get out of the positions when we need to. And the way this works is when you as a bot creator send us a signal, first thing we do is we make sure that it passes the safety check from the liquidity model, and then it can go to market. So what we've learned today is what is liquidity, and basically that's just how much is available at any given price. What is the liquidity model? It's basically nothing more than a formula that looks at how much liquidity is available on average. And the main takeaway that you should take from this story is try to stick to the larger coins, because there's a lot more volume there, which means that your bot can also grow a lot more than it otherwise could. So best of luck, and if you have any questions, please drop them in the comments, and also have a look at our market cap video. See you next time.